What I'm going to take you through now are some pitfalls or some things that you really need to be aware of if you're looking at lump sum insurance. Now, lump sum insurance is effectively life, TPD and trauma insurance. There are a few others, but those are the key ones. Now, what you need to be aware of is really how you pay for it, which is your premium structure, which can be level or stepped or hybrid, but we're just going to deal with level and step today. And you also need to know about the sum insured. So whether that's agreed value, whether it's indexed, or whether it actually declines over time. It's really important to know these because you need to know that what you're covered for now is going to be covering you for what you need to be covered for in the future. So let's have a look at the payment. There's two types, and I'm going to whack a graphic up on screen to actually discuss this, but there's stepped or level cover. Now, stepped cover is cheaper initially, and that's why a lot of people have it because it's far more attractive. But what we find is level cover, especially if you're younger, is far more attractive because over a period of time, stepped cover increases exponentially as you get into what we call the risk zone. The risk zone is effectively the zone where you're more likely to claim on a policy. Whereas level cover, or level premiums rather, actually stay and remain constant over time. So check out level cover. It might be more expensive up front, but you may save tens of thousands, if not hundreds of thousands over a long period of time. The other thing that you really need to be aware of and to ask the questions about, and if you've got an industry fund you may fall into this loop as well, is because there are three types of lump sum cover. That's fixed level cover, which means if you've got $1 million, you've got $1 million for life. As long as you pay for it, you're going to have that cover. You've got indexed, which effectively means every year it's going to go up by either AWATI, which is basically your average wages, or it's going to go up by CPI. So $1 million today is worth the same amount of buying power in the future. So if it's level cover or index cover, fantastic. It just means that whatever you're paying for, that's what you're going to receive, and if you want to decrease it over time, you can. But where you really need to be careful, and where I've found clients have come unstuck, is where they've got declining levels of cover or declining sums insured. They may pay the same premium over a period of time, but in fact their insurance falls off. So it might be worth $1 million today, but in 10 years' time it might be worth 500, and then in 20 years' time it might only be worth 70. So these are the things that you really need to be looking out for in your policies, and if they haven't been explained to you, well, now you know to start to investigate.